Sustainable Finance Webinar. So it's our first session of 2021, and we'll be focusing on getting ready for the 10th March SFDR deadline. Now, working towards and meeting the March 10th deadline has been a challenge for most financial market players, not least given that there are still some requirements that will only be clarified after the 10th. So the purpose of today's 3 sessions is to give you examples of how asset managers are implementing SFDR and to give you an opportunity to ask questions from the experts. Today's sessions are in collaboration with Arendt Medernach, Linkletters, and GSK Stockman. And I'd like to thank them and all of our speakers, including the representatives from the asset management firms who are speaking on today's panels. So sustainable finance continues to develop very quickly, and LuxFLAG continues to contribute to this development. At the end of 2020, LuxFLAG labeled 322 investment products. We saw 76% growth in 2020, and assets under management have also grown to 135 billion euro. As a reminder, LuxFLAG offers 5 labels. Its ESG cross-sectorial label, where we've certainly seen the most growth over the last couple of years, and 4 thematic labels: microfinance, environment, climate, and green bonds. So the first LuxFLAG label was offered in 2006, and I think it's important to note that as sustainable finance grows and evolves, LuxFLAG will also grow and evolve, including its labels and the label criteria, and we will continue to align these to EU initiatives such as SFDR. And in addition to offering labels, LuxFLAG also plays an important role in advancing the sustainable finance agenda through education, networking, and sharing of best practices, in large part through its associate member program. We have approximately 90 members from all aspects of the ecosystem, so law firms, auditing firms, asset managers, service providers, and others. So many thanks to all of LuxFLAG's associate members for your contribution to moving sustainable finance forward. I look forward to seeing you all this year, remotely of course, but also hopefully at some point face-to-face. So we have a lot on the agenda, and without further ado, I'd like to hand over to Sachin Vankalas, LuxFLAG's General Manager, who will introduce today's agenda and moderators. Thank you.
Thank you very much, Denise. Good morning, everybody. It is a big pleasure to welcome you all after our last events back in October. As you are aware, these type of events are organized with our associate members, which are our partners, and are meant to provide a concrete platform for our members to showcase their actions in sustainable finance as such, or initiatives in sustainable finance as such. Towards that end, SFDR being the most important topic or most discussed topic these days, we thought that this is very right time to organize webinars on this very important topic. So for that, today, we are joined by 3 of our associate members, Arendt, Linkletters, and GSK Stockman. We will have 3 different webinars. So 9 to 10, 10 to 11, and 11 to 12, each hosted by a different partner, and covering, of course, though SFDR is one topic, there are very many aspects, very many questions, which are differ from each other, and they will be covered in different sessions. So the first session, which is organized by Arendt from 9 to 10, will be mainly looking at the practical implementation of SFDR, what kind of challenges and opportunities are there in terms of fund categorization, how the AMF approach is towards SFDR as such. So those are the points which will be covered by Arendt. Then we will have Linkletters, which will be covering more on the SFDR and AIFs. What is the story, or what AIFs are being impacted with SFDR? Then how the actual meaning of promotion from Article 8 would be. So all those aspects would be covered in the Brexit, of course. Linkletters, which is the Linkletters London, is actually participating also on this seminar. So Linkletters will cover also the aspects related to Brexit and SFDR. And then the last session, starting at 11, will be hosted with the partnership of GSK Stockman, which will be covering also particular matters related to small asset managers as such, or third-party mancos. Now, before going forward, just a few logistical remarks. All recordings would be made available to you by email just after, once we finish the webinars. Questions are, of course, welcome. You can ask them by putting them on the chat box, which you see on the right-hand corner of your screen. There are no slides as such, but if there are any questions, of course, LuxFLAG remains at your disposal for all of those questions. And of course, I kindly ask all the speakers also, while they are not speaking, please stay on mute so that there is no disturbance. Yeah. Okay, towards that, now I hand over for the first webinar, which is organized by Arendt. I hand over to Stefan Bade, who is with Arendt. Stefan?
Thank you, Sachin. Thank you, and good morning, everyone. Indeed, very pleased to welcome you at these sessions where we're going to hear from the market. We're going to hear from the practitioners which have started this journey towards complying with the SFDR. I mean, as Denis said, this publication really marked a new milestone in the European Union journey towards a more sustainable finance sector. It was part of the action plan on financing sustainable growth, and so it's very important steps, because obviously we want to all to succeed. Starting to work on this, and you hear me well? Yeah, because not sure. So with me today to discuss the implementations and effectively some of the hurdles that they may face, I'm very pleased to welcome Agathi Pathili, which is Head of Government Relations Europe at Capital International Management Company, so for part of the Capital Group, and for that, it was working very well. Okay, do you hear me better? Yes. Okay. Let's do it like that. Sorry for the technical issue. Anyway, well, without waiting more, so maybe starting with you, Agathi. So how have you tackled this issue? How has it been done within your group?
Yes, good morning to everyone, and thank you, Stefan and LuxFLAG, for today's panel session and giving us the floor. It's I guess very important at this stage, looking as to how we have been seeing implementation of SFDR, and with the deadline approaching very fast on the 10th of March, it has become very clear to us, as I think as others in the industry, that there is a lot of absence of legal clarity. Therefore, having discussions with the industry and with regulators is really helpful to try to establish at least some common understanding within the market, waiting for further regulatory clarifications. So I guess my first remark as to how we have been preparing and how we have been seeing the implementation of the Sustainability Disclosures Regulation would be exactly that. It's been almost a year now that we started our implementation project, and we have been struggling, firstly, with a lot of clarities that we found. at the level 1 text. Then we followed the consultation that closed in September last year around level 2 measures and how to further clarify the disclosures around product requirement disclosures or at the entity level. We believe still there are many points left unclarified, but nevertheless we decided to proceed on the basis of either some common understanding within the industry or on the basis of the understanding that came via regulators at the European or national level. So from our side, we needed first to see how we can capture the disclosures at the entity level. There was a clear threshold of 500 employees that made a difference as to whether these disclosures were mandatory or not. In our case, they were not mandatory. Nevertheless, given our ESG profile and our commitment to ESG risk integration at the entity level, we decided to, on a voluntary basis, to already comply with the regulation when it comes to disclosures on how ESG risks are integrated in risk management processes, in remuneration policies, and we will be ready to publish all the relevant statements at the website by the 10th of March, which is the deadline. And then secondly, we needed to see how to meet the requirements for prospectuses of funds, make the distinction between Article 6, Article 8, Article 9, decide internally how our funds should be categorized concerning these marketing options, which was already a very difficult exercise. I'm sure we will be coming back later on to that. It has been a very difficult exercise due to important regulatory unclarity that still persists. So our main guideline there internally was to make sure that we provide robust and clear information to our investors that is not contradicting, first of all, how our ESG risk integration process is taking place at the entity and at the product level, whereas at the same time not being misleading to investors as to what these funds are actually targeting at. So we made this decision. For the time being, we decided for Article 6, and of course, we are still open to further assessing possibilities, mostly as we see further regulatory clarity as to where to put the line between Article 6 and Article 9. Altogether, it has been a challenging period, especially due to the fact that there are more that there are as to how PR should apply.
Thank you, Agathi. Just one point, Agathi, which strategies do you cover? I think it would be good for the audience to know what type of strategies you are covering.
Well, it's important to note that we are an active asset management offering UCITS funds. So in that way, all our strategies are related either to equity or fixed income, but they're all active strategies. We don't offer ETFs. And at the same time, our ESG risk integration process, important to note as well, and this is the type of information that we will be communicating to our investors, involve both reliance on third-party service providers' data as well as our own engagement, which we believe we have a strong asset there, our own engagement with invested companies. I hope this covers in a nutshell your question, Stefan.
Oh, thank you very much. Thank you. Thank you very much for that. So Maria at Edmond Rothschild, how was this process gone?
Well, I'm pleased to have the opportunity to share our experience on this very important topic. We are all concerned. So if you allow, I would like to take a step back to describe very briefly how we position ourselves into the sustainable investment space, and then to better understand how we approach the SFDR regulation. So what is important to understand, there are 2 points, I think. First is that for Edmond Rothschild, sustainable investment is really rooted in its DNA. We are a family-owned independent company with a background also in real asset investing. So we have been in this space for a long time with impact fund, and we have really a philosophy where we want to contribute to shape the real economy. So we clearly look in our philosophy beyond performance, and this has been for a long time. We are also a very early signatory of the UNPRI, which also shaped our trajectory towards sustainable investment. And today we have, broadly speaking, as a group, about 20 billion in what we can call sustainable investment. There's one philosophy, very pragmatic, but we have different graduation, I would say. It starts from the impact funds, particularly in the private equity space. We have impact funds, we have SRI labeled funds, quite broad range. We have ESG integration and sustainable thematics. We cover all asset classes, nearly all asset classes in the real asset space, so private equity, infrastructure debt, real estate, and in the liquid space, equities, fixed income, and asset allocation. I think this is important to understand how important this regulation is for us. And a second important point, I think, is to understand that we are doing our own ESG research. We do our homework. We have a detailed proprietary ESG methodology. We look at a lot of data, and we are looking a lot of data primarily coming from companies. So this is important. So within this context, we look at ESG regulation from a risk perspective, but also, and this is very important, from a business, from an opportunities perspective. And what is interesting to see for us today, that the market forces you talked about, there is a big move towards sustainable investment. Regulatory forces are now on a European level, but also on a local level, are joining the market forces, so make a big move towards sustainable investment. So within this context, how did we tackle the situation? Well, the first is we made a broad analysis of our funds to see how we could position them within the SFDR regulation. Well, it's Article 8, Article 9, Article 6. How would our ESG integration fit into this category? And as a kind of gap analysis, would we need to change things or should it be fine? As a second important point is we are an asset manager with most of our asset management done in France. France is a big market. We are European, but still our main regulators are the SFDR in Luxembourg and the French AMF. And as you probably know, on the French side, there has been a new SRI doctrine, which also comes into force on March 10th. So it's really the same timing as the SFDR regulation. So of course we have to tackle both at the same time. And as we are very pragmatic, I think we start from the local perspective to go to the broader European perspective. So we have first looked at our funds from the AMF perspective, which is also requires a kind of categorization of funds with binding communication rules. And the goal is clearly, it's why I emphasize in my introduction our importance of sustainable energy, to get as many funds as possible into the, what I call ESG integration category, which would be the intermediate category of the AMF. So this has been a huge work. What we have seen is that we needed to upgrade our ESG methodology. Basically, to make it short, we have moved from an obligation of result to an obligation of means to now to an obligation of results. And as far as we interpret the latest statement of AMF, we are quite comfortable that this requirement of the intermediate category of AMF would fit into category 8 of SFDR. So this is on the French side. We are less comfortable on Article 9, which are impact funds. We have some specific impact funds, as I mentioned, on the private equity side, but it's clearly, well, the requirements are less obvious. So we go for Article 8, Article 9. I would say on the liquid space, at least I would say 90% of our mutual funds. Of course, on the dedicated funds, we are working on a client-to-client basis. So we have worked on our methodologies. We do we did a huge chunk of our also with portfolio management because, well, to come back to the requirement of AMF, basically obligation of results means to have an ESG rating above your investment universe. well, this is a result, but of course, these changes might change also the investment process of some of our funds to reinforce this aspect. So this work has been mostly finished. Today, we have categorized all of our mutual funds. We have amended the prospectus, so it as relates to the investment objective and as relates to in the investment strategy. And these prospectus are currently being submitted to the ESSF or to the AMF regulator. In parallel, we have also upgraded, I would say, our databases, our tools, monitoring tools, to give the portfolio management additional comfort to steer their portfolio from an ESG basis. So
thank you, Maria. Maybe just because I'd like to pick up on one of the points you've raised here, which I think is very interesting and which is probably very interesting for the audience. And really thank you for the detail you've been giving here. It's really on these Article 6, Article 8, and Article 9 categorizations. And I would like to go back to Agathi on that, because I know she was part of the discussions that were held at EFAMA. And so Agathi, we heard Maria that it was a difficult choice, still a difficult choice, even for a firm like Edmond Rothschild, which is, as she said, very involved and been involved for years on 8 or 9. So what is your view on that? What are the kind of the blocking points, or what needs to happen?
Yes, thank you, Stefan. So in our view, this is, and again, I think I'm echoing the general industry view here, that this is still very much an unclear point. On top of that, and concurring to what Maria just mentioned, we also have different categorizations coming from the national legislation as well, different doctrines such as the IMF one, which makes things even more complicated. But going back to the Article 8, 9 and Article 6 requirements that will apply regardless to all jurisdictions, the key point in our view remains that the triggering point between Article 6, which let's say are funds that do not promote ESG characteristics and don't have sustainability as their investment objective, and Article 8, which is the next step. What is the triggering point? What is it that it means to be promoting ESG characteristics? And what are those elements that would allow this classification for a fund? So taking the extra mile of not just having ESG risk integration, but also be actively promoting ESG characteristics, is still largely unclear. There was, as I mentioned, the ESAS consultation that was launched back in April last year. And there were some remarks such as, it isn't enough to have exclusions in a fund to build the triggering to become Article 8. That is a clear point in the consultation, meaning that it's not, Article 8 is not reserved for only investment strategies that are based on exclusions. At the same time, there was different narrative within this consultation that was clearly indicating some binding elements in the investment decision-making process, binding elements at the level of the fund and not at the level of how ESG integration works at the entity level. So binding elements, in our view, means that at the end, the asset allocation, the asset selection needs to be based on elements that precludes an investment decision, that leaves no discretion, as long as, of course, these binding elements kick in, for the portfolio manager. Based on that, it became rather difficult to consider that an ESG integration policy defining the main guiding principles, but without concrete binding elements at the level of the fund, becomes more difficult to be able to classify a fund as Article 8. And therefore, Article 8 becomes much more onerous, much more, yeah, I would say much more difficult. Also, we took into consideration the fact that there is a clear requirement under SFDR that the information provided to investors shouldn't be misleading. And we took note of what, for instance, the regulator said, that just the exclusion, the mere exclusion of 2 or 3 assets of investing companies wouldn't be sufficient to classify a fund as Article 8, let alone as Article 9, where we are closer to impact investing. where in our view things are perhaps a bit clearer, because sustainability has to be one of the investment objectives of the strategy, and therefore putting all these elements together. And in addition with that, we also needed to take into consideration that there is a lot of ongoing discussion at the level of MiFID as to how sustainability preferences of clients should be taken into account, and when distributing a fund, what would it take to distribute a fund as Article 8? And then the Commission came with different approach to what we think SFDR is, because the Commission approach is that either it has to have a binding element, or then it made a connection to principal adverse impact, so that the fund needs to already incorporate principal adverse impact, which is an additional element not coming from SFDR. So in this widened clarity, it became clearer to us that we need to stay consistent with the information we provide to investors, again, not being misleading, and perhaps it's perhaps the safe road for the time being, but it seems that the bar is going to go higher and higher when it comes to Article 8. Therefore, we firstly prefer to have some legal clarity rather than jumping and seeing a market, many either product manufacturers or distributors claiming that all their funds are Article 8, which at the end will create a bubble and risks of greenwashing.
Thank you, Agathi. Thank you. So maybe before going back to Maria on the IMF and the way the IMF has positioned itself, which makes some links to what you said, Antoine, in all the clients that we have, I mean, do you have a view what our clients are opting for? Is that Article 6, Article 8? Is it consistent? Can you give us some views?
Yes, hi. Thank you. Not sure I want to commit to a strict figure. But I think what is clear from Maria's testimony, Agathi's testimony, is that the market is struggling with, on one hand, the need to go through this transparency exercise that's requested by the SFDR, right? So give more information and communicate maybe a bit more on what you do on those issues, versus on the other hand, the need to not expose yourself to greenwashing, accusations, and not go too far, and respect, be in line with what investor expectations will be for an Article 8 or an Article 9 product. And I think Maria's and Agathi's discussion, illustrate this discussion we see in the market. And indeed, when you look at the draft RTS, the background analysis, very clear that unlike what was initially communicated, that simple exclusions would be enough, there is now acknowledgement that some exclusions are very, very, very basic and have a very, very limited impact on the investment strategy, and this should not be enough to sort of jump the line and go into the Article 8. And I think this idea of you need to be comfortable with what you're going with for the Article 8. For example, Maria, you said you want to go for the intermediate category for the AMF doctrine. That's already quite stringent, right? That already goes a bit further than SFDR. There is this requirement to demonstrate that it has a significant impact on the investment strategy. So that's something we really want to make sure that everybody keeps in mind. Also, because when you look at the level 2 that's in draft of the SFDR, there is this idea, if you look at the recitals that are proposed, that by the level 2, you will have to give end investors an idea of the materiality of your approach. So there is still no minimum threshold, there is still no mandatory minimum, but you have to be clear about the materiality, and you have to allow investors to have an idea of how material your approach is. And what we want to avoid, right, is that you categorize Article 8 today, and in January next year, you need to put in your prospectus or marketing documentation that actually what you're doing is, has a very, very limited impact on the investment strategy.
Thank you, Antoine. And so maybe because we talked a lot about this IMF doctrine, Maria, do you want to give us a brush view of what is the IMF position in that respect?
Yes, of course. The overall goal, as for the SFDR regulation, is really the other person also underlined, is to avoid any greenwashing. And the IMF regulation is much about proportional communication. It means if you have no ESG real characteristic, you would not be allowed. If you have some, you could communicate in a proportional way. And if ESG is a central part of your investment strategy, you can communicate in a proportional way. That is to help really the end investor to clarify. And there are basically, three categories. The first one is no ESG. You are not allowed in your marketing documentation and so on to pretend you have to do anything and you have anything on the ESG side. There's the intermediate category, which is ESG committed, but it's quite stringent already because, as I told, we're going for this, you have already an obligation for result. Basically, you need to have an ESG rating of your fund above your investment universe, and you need, according to the investment universe, at least to cover 75 or 90% of your investment universe with an ESG analysis. So this is quite demanding. And then you have the significantly committed category, which goes beyond, there are different approaches. One approach is, for instance, based on selectivity, which corresponds in a certain way to the French SRI label, which requires, among other things, to have a selectivity for at least 20%. And so these are the broad categories. And of course, we started with this one. It is very concrete and with the elements, and preparing at the same time, let's say, the background, the work with the portfolio managed implementation of these binding elements in the prospectus to be ready to jump on the SFDR regulation. And this enables also, if we have to adjust some parts of our methodology, and we will be able to do so. So I think the IMF regulation is quite a good point. And to add what Agathi said on the exclusion side, it's not sufficient, clearly. Also, currently, there are some interpretation in the local market which are more focusing on the exclusion side. So basically, we have some exclusion, but we are not concentrating on exclusion, but really what is happening in a binding way on day-to-day portfolio management. I think that's what the client expects and what the regulation should favor.
Thank you, Maria. So, I mean, at least, you know, as we mentioned, you'll be aligned with the recital 24 if it stays into the new RTS. So, you know, I think all the audience has understood that, you know, this first exercise of categorizations has been led to quite a lot of thoughts within the industry. No alignment. I think that's what I would retain from that. Agathi, you mentioned something also very interesting is, you know, once you've passed that, once you've ticked that categorization exercise, then you have effectively the question about the principal adverse impacts. You know, do you want to take the principal adverse impact into consideration or not? So what was your position on that, and you know, how you see this evolving?
I guess so. On the principal adverse impact side, important first of all to keep in mind that the first deadline relates to disclosing principal adverse impact and how this is considered at the entity level. So not updating prospectuses to reference how principal adverse impact is or isn't considered at the level of the investment strategy of a specific fund. Now, at the entity level, I briefly mentioned that there is the threshold of 500 employees. Very interestingly, the ESAs really at a very later stage, 3 weeks ago, 2 weeks ago even, they came up with a letter asking whether how the 500 employees threshold needs to be calculated at the level of its entity, so even at the subsidiary level, at the level of the parent company, at the group level. But regardless of this, which we believe even adds to the unclarity of the discussion around the implementation of SFDR, as long as this threshold will be met, the requirement is to disclose how these negative externalities occur at the entity level. Again, parent company level, group level, or subsidiary level. And in our case, the 500 threshold isn't reached. However, we decided, given our extensive efforts on ESG integration strategies at the entity level, to already produce a statement disclosing how we consider principal adverse impact. To begin with, principal adverse impact, the disclosure via the website statement that will take place as of 10th of March. And I think for larger companies will take place as of the 30th of June, needs to, for this first year, reflect in a general way what are the policies an asset manager has in place, again, the entity has in place to consider principal adverse impact. At a later stage, though, and this makes it very important how the statement takes place this year, because next year the requirement is going even further, asking to calculate principal adverse impact against a detailed list of indicators. Again, due to extensive legal unclarity, we don't have yet the final list of indicators. We had an initial understanding of this list via the ESA's consultation paper that went out in April last year. This was an extensive list of indicators, 32 indicators that asset managers needed to take into consideration, regardless the underlying investment strategy, regardless the asset classes. So we're talking about an extensive list of indicators that, in our view, don't necessarily reflect every investment strategy. They are not necessarily relevant for every asset. So I think there was a very strong pushback coming from the market as to the efficiency and how realistic it is to calculate on the basis of this very extensive list negative externalities. And from our side, and I think from others as well, there has been skepticism as to the added value of having negative externalities calculated not at the level of a fund, because there it is disclosing something relevant and important for the end investor. You are disclosing as an asset manager how negative externalities are considered or not, and how much of these negative externalities exist at the level of the product that the investor is invested in. But having this calculation at the entity level is aggregating what happens in different investment strategies, giving a general idea that we wonder how much it is really relevant for an investment decision making, which always and necessarily relates to a specific investment strategy and to a specific product. Regardless, as this is the requirement, we will be making, as I said, first of all, the high-level statement by March this year, and then following the detailed disclosures as of next year.
And finger crossed, Agathi, from what we heard, the Commission has heard the plea of the asset management industry, and these indices or indicators will go down. So we need to see what's coming up for us. Antoine, what Agathi has mentioned, is that something that we see across also our clients, that where PAI are not being taken into account, or are people gambling on the fact that they'll be ready when it's time to report?
You're pushing me for figures and statistics again. And I'm not sure. I think, similar to the product categorization, it's very difficult to see a trend emerging. To get back on the categorization, I think what has people worried is that everybody would go into Article 8 and you'll be the only ones left without Article 8 products. That's not happening. Definitely not. It will not be like everybody will be Article 8. And on the adverse impact, in terms of whether or not we take into consideration, it's really, at the moment, it's really hard to see a trend emerging. It's true that legal uncertainty and all the arguments behind the fact that there is no data in quality and quantity, that arguments are still being brought forward by some participants.
And you mentioned earlier, is the materiality issue, you touch base on that? Is that something that our clients have in mind also when they do their classification? Is that like something that when we mention to them these materiality concepts that make them revise maybe their position?
Yes, yeah, no, I think the AMF doctrine, but also the work that's going on in Germany with the VDI and the minimum criteria, all this has sort of, got everybody thinking and raised awareness on this idea that, being comfortable with your approach is very important. So indeed, when we exchange with some of our clients and we have a look at their ESG approach, if we point out some weaknesses, or if we highlight the impact that the approach has on the portfolio, that's often something that's welcomed and that is taken into consideration. Yeah, for sure.
Okay, thank you, Antoine. Maybe to round up, and before we go to the audience for questions, I think one of the all of this is done for investor transparency and again for funneling money to sustainability investments and funds. What is the client's demands? I mean, do you feel your clients' pressure? Have you seen like even more raising interest? I mean, we've seen some amazing figures in terms of the growth of ESG funds or ESG label funds. So, Agathi and Maria, what would be your perceptions on that? Maybe starting with Maria.
Okay. Yes, clearly you're right. There is a strong pressure coming from clients. Well, it's a positive pressure. We have been already seeing many of our clients, particularly fund selectors, asking on a commitment from our side for category 8, basically. So, and basically category all of our funds. So this is coming from most of clients from all European countries. But I would say this is a starting point, and most clients want to go beyond. To take it also as a new opportunity to dig deeper into the different ESG strategy, which are about materiality, so to make sure there's really something happening in the portfolio, there is a real impact. So we are working closely with several clients, let's say also on the dedicated investment side, to reinforce and to improve the ESG profile from different funds. So this is a very important move. What is a more complicated thing, but we are seeing from clients that there is this overall SFDR regulation, European regulation category 8, but clearly there are different interpretations. So we have clients in France which are very comfortable, obviously, with the way we see Article 8 going through the AMF. On the German side, it's very different. So, for instance, we have statements with clients relying on the German fund association, which are much more focusing on exclusion. So we are in a kind of weird situation where we might be Article 8 in France for French clients and not Article 8 for German clients, which is clearly complicated to handle. But the demand goes clearly strong for ESG integration.
Agathi, would you share the feeling?
I would definitely share the feeling that there is a growing demand, surely. We do receive that from fund promoters, distributors, also institutional clients. Of course, at the same time, we see some differentiation among different jurisdictions as to the level of demand, but there is a clear trend for Article 8. We also try to understand if this demand is linked to the fact that either the institutional investors or fund promoters and distributors have their own requirements, internal requirements to meet, and they're therefore interested only on the pure side of how a fund is classified as Article 8, 6, or 9, or whether there is a real appetite to look through the actual ESG investment strategy at this fund, rather than just take a tick the box, deal with that as a tick the box exercise. As long as it says it's Article 8, everything is met. As Capital Group, we prefer, however we classify the fund, to be able also to defend the case should it be that the market wants to have a look-through approach. So we're taking the longer way, the more difficult approach, but we prefer to be able to substantiate that this is indeed an Article 8, or Article 9, rather than just classify. The last point I would make, and echoing what Maria said, we also see that there are high risks that what is Article 8 in one jurisdiction may not be Article 8 in another jurisdiction, and that for a cross-border marketing of funds purpose is of course an important barrier.
No, that would be indeed really a nightmare for all of us. Thank you, Agathi. Thank you, Maria. I mean, I really like to thank for your contribution, which I think was extremely insightful. Thank you, Antoine, also, and sorry for putting you on the spot for some data. I'd like to also apologize to the audience on the communication if it wasn't good at the beginning. Thank you again, and I let Sachin to read or communicate some of the questions from the audience? Yeah,
Stefan, thank you very much. It has been very, very interesting, all of the speakers. You were looking for some data, and I'm happy to share some data. We, as you know, we label at present 322 products among our all labels, and out of which 246 are ESG label products. And of course, we have reached out to all our label products, asking them where they are in terms of SFDR, what they are doing, what categorization, and what timing, right? I wouldn't give you exact numbers because we are still following up with some, but it is very, very clear that the response which we receive from label funds, meaning 246 ESG funds, except some very minor exceptions, they are all going for Article 8. They all know what is SFDR, and they all have been preparing and going towards the filing. Of course, as expected, the climate finance label funds, microfinance fund, more impact-oriented funds, naturally, most of them or almost all of them have decided to go for Article 9 and of course are preparing the filing. Of course, there is a bit small proportion of label funds still deciding between being ESG but still want to go for Article 9, or being ESG label but still want to stay for some time in Article 6 and consider a transition to Article 8 over 3 to 6 months in the following months towards the end of the year. So yes, there are minor, let's say, considerations still being made, but for us, it's becoming very, very clear that ESG funds going to Article 8 and impact funds going to Article 9 and already being prepared for filing for that. Now, that of course naturally means that the LuxFLAG labels, as Denise mentioned in her introduction, LuxFLAG label will be considering the SFDR implementation in its criteria, and of course those will be made available to you towards March with the revised version of the criteria, and of course the overall approach LuxFLAG will be using towards analyzing and reviewing those factors. Now, well, thank you again once more for very interesting discussions. Some very interesting questions coming up. I can take some of those. Let's look at how does the requirements will go for non-EU AIFs registered for marketing under NPPR regime. Who would like to take it?
Maybe probably it's a question for myself and Antoine. I think they are still again also debate, but our view is that so non-EU IEFM would not be in scope in terms of the rules for entity level, where obviously the product and disclosure that needs to be made on the pre-marketing documentations will fall in scope and will have to comply, which raise an awful lot of questions. There's also the questions for non-EU managers, which are being served in Europe by a management company. What is the, I would say, knock-on effect on them? Because again, in terms of risk integration, even if you are in Article 6, they will need to communicate and they will need to provide some information. And so that's where we stand today. I have to say that SFDR, which is very much EU, is kind of sprinting around, and we see also initiatives going up in other parts of the world. I think Hong Kong, for example, had some initiative, and also with the change of TAC in the US, probably some news also to be watched on that space.
Thank you, Stefan. Towards the same line, one more question which comes quite often is how about discretionary portfolio mandates? How the disclosures will apply for discretionary portfolio mandates on their website, or whether there is also a question around the GDPR obligations. So how would that all work?
Yeah, again, I think that was a question that was raised during EFAMA, and which was sent back to the commissions. The feedback that was received from the industry is indeed it should not happen at portfolio level for I don't know if it's GDPR, but at least for professional secrecy reasons. You don't want to disclose and give information on a specific mandate of one of your clients. So this is something that is going, I think, today from the EFAMA to the commission, and we'll see how this goes.
Okay. Around the same lines, one more question is about the third-party mandates and fund of funds. How would those type of products need to be adapting to this?
I don't know, Agathi, Maria, do you have fund of fund in your portfolio?
Not really our scope.
But could we conclude that at present we don't have a very clear information on how to approach to that, or do we already have some?
Antoine, maybe you've come across this in our.
Yeah, we came across a few products that have fund of fund strategies and would like to go for Article 8, even for Article 9 categorization. And I mean, it's a case-by-case analysis, right? Because you can implement, you can do this in a lot of different ways. You can either, you target only labeled products. It becomes tricky when you handle exclusions because you want to make sure that the funds in which you invest have the same exclusions. So there is maybe an additional level of complexity, but it's possible to articulate binding strategies that would work in a fund of fund setup. I think we have a few questions on, is there a minimum requirement for the screening? There was a lot of questions. There was a comment on, if you have very simple exclusions, but it's binding, then, you could argue that you don't want to over-disclose on sustainability. There was also a reasoning around if I say I include only in weapons, tobacco, and gambling, but I take the best in class in those industries. Is this a best in class approach? I mean, the idea is to be clear with what you do and also to be ready to defend this towards end investors, right? You need to be comfortable with your approach. In order to assess this, we ask 4 questions. Do you have a binding criteria? So is there a binding non-financial criteria that is systematically applied and that systematically will make the investment decision? So is there a binding criteria? Is it applied to a large portion of the portfolio? So does it cover almost everything in your portfolio? So we don't want to see exclusions of gambling and tobacco, and 50% of the product is made of government bonds, which derive millions of revenues from sales of tobacco, probably support nuclear programs for electricity or even military. So is it applied to a large portion of the portfolio? Is it applied on an ongoing basis? So we see a lot of participants with internal ESG scoring or internal methodologies. So how often do you review your rating? How often do you review those characteristics to make sure that the portfolio remains aligned with what you have promoted? And finally, does it have a material impact on the investment strategy? So is your product really different from a standard Article 6 product? So if you can say yes to those 4 questions, you're probably on the very safe side in saying that's an Article 8 product, I make promotion around those characteristics, and I'm ready to defend this with end investors.
Right. Thank you, Antoine. Of course, there are so many questions seen by us, still many around. Can you please mute? Yeah. Yeah, so of course we have so many questions received so far by around exclusions and around investment strategies, but as you would imagine, that's a whole lot of a discussion topic for another separate webinar. We're just left with 4 minutes to go for the next session, so I would like to, at this present time, thank, of course, Arendt for hosting this, and Maria and Agathi and Antoine for being available to speak. Of course, it has been a very, very interesting discussion. For the audience purposes, unfortunately, we could not take all the questions, but of course, LuxFLAG remains at your disposal for all those questions. We can certainly organize another webinar or another consultations in some way so that most of your questions or all of your questions could be addressed. So keep in contact with LuxFLAG, and we certainly can develop something. Now, for the next session, for the audience purposes, please note that the WebEx link will change. So you have a second link. We'll be starting in 4 minutes with the next session, which is hosted by Linklaters. So thank you very much, Arendt, Stefan, Antoine, Agathi, and Maria. Thank you, audience, for joining. And of course, we look forward to see you in 4 minutes. Thank you very much.
Thank you.